Thank you for coming on with me.
You're
To,
welcome.
to everybody who is watching this that doesn't know the other lady on the screen, obviously y'all know I'm Jenny, with Jenny and Co. But this is Debbie Jacques with Alcova Mortgage. She is one of our favorite lenders, who really knows their stuff. And the purpose of this call or this recording today is to help educate you guys on some things that we've learned from them on something that's not new, right? It's not new.
No, it isn't new. It's actually a very old program, but a
Yeah,
lot of lenders just haven't used it in a while.
right. So a strategy in this market when the interest rates are high, the buyers are struggling to swallow the payment that they are seeing, but also a strategy for sellers too. So we're going to talk about what a 2-1 or a one, what do you call it? A 1-0,
1-0.
1-0 buy down or a 2-1 buy down. And I'm going to talk like, and I clearly don't know all the things. So I'm going to just ask the questions that I hope that the people that are watching this might have. So let's start with like the basics. So a 1-0 buy down and a 2-1 buy down. What is it called a temporary buy down? Like, what is the terminology that we should be saying?
Okay, yes, it is a temporary seller buy down.
Okay.
So in a 2-1 buy down, the rate is going to be bought down for 2 years. The first year will be bought down for 2 points. The second year will be bought down for 1 point.
Okay.
Okay.
So the two stands for 2 years and 2
Yes.
points. Okay.
Yes. Yes. And then the second year, you would be reduced for 1 point for that second year.
Gotcha.
Okay.
Okay.
And then the 1-0 buy down would just be for your first year, you'll be reduced 1 point, and then there's nothing else. It
Okay.
goes back to the regular rate.
Okay. So it's temporary is what we should know. And
Yes.
it's dependent upon which one they choose. So there's options 2-1, 1-0, whatever it is. And then that's something that you guys would counsel them through on what's the best option based on their situation.
Yes.
Okay.
Yes.
One disclaimer I want to make before we go any further is that what we're talking about today is Alcova Mortgage's product. It doesn't mean that every single lender is exactly the same. We all know that lenders have different products. Debbie just happens to be my go-to, and so she's going to talk about their product. Don't like negate anything she says because that's just theirs. It could be something else somewhere else. And it's also very important to know that each borrower is different and their qualifications and things like that. So, okay. So I think we got the basics.
Yes.
2-1, 1-0, 2 years, 2 points, 1 year, 1 point. Okay. I'm with you. Anything else you want to add on the basics?
No, that's good.
Okay. So tell me if a buyer, if we're talking to a buyer about why they should consider this, obviously the obvious answer is because it helps their rate. So if they're at, for today's call, we're going to pretend the rates are at 7%. Okay.
Okay.
So if the rates are at 7%, give me an example of what it would look like for a buyer. Tell me the type of loan it is, like for our contract purposes, what kind of loan is this? And what does that look like for a buyer?
Okay. So first of all, the temporary seller buy down is available on conventional loans that are insured through Fannie Mae or Freddie Mac. They're also available for FHA and VA loans. Okay.
So
it
conventional
kind of
FHA and VA. Okay.
Yes. So it encompasses pretty much all of the loan types that are out there, aside from all of your main loan type. So when you say a temporary seller buy down, the product that we have, the seller is actually the one that is funding the buy down. Okay.
So the seller is the one that's paying for it, and that's a requirement.
Yes, it is a requirement that the seller must pay the fee to buy down the rate. And that is usually done through grabbing some closing costs. And now that, buyers are kind of feeling like they're out of the market, they're going to wait a while. We should be seeing agents being able to capture a little bit more closing costs,
Yeah,
whether
we
it
have
be
seen that.
enough, yeah, for a 1-0 or a 2-1.
Right.
So when you look at a 2-1 buy down, let's say the rate today is 7%. Okay. Um, the rate for the first year, if the buyer decides, hey, I want to try to do a 2-1 buy down, the rate for the first year is going to be reduced to 5%. So that takes a lot of weight off their shoulders for that first year. Then the second year, their rate would go to 6%.
Okay.
And then the third year, it would go back to the 7% that it
Right.
is
So
now.
the initial rate, it goes back to
Yes.
the initial rate. What was the one
Yes.
thing you told me on the qualification of a 2-1 buy down? They have to qualify to the current rate.
Yes, yes. On any
Okay.
seller buy down, the buyer is always qualifying on whatever the rate is going to be,
Right.
their final rate. Okay, so if today's rates are 7%, they would qualify at 7%. If today's rate 7.5%, they would qualify at 7.5%, regardless of how much that rate is bought down. So, as lenders, all of the banks out there want to make sure that the buyer can qualify with whatever their standard rating.
Okay. That makes sense to me. And so the fee that is paid by the seller is different based on the loan amount, purchase price, qualification. Like, tell me how
Yes,
the fee is calculated.
yes. Okay. So the buy down fee is calculated on the loan amount. So it does differ depending on what is the purchase price, what is the down payment, and what is the final loan amount. That is what is going to give you however much you need to collect. And of course, a 2-1 buy down is going to cost more than a 1-0 buy down.
Right.
Okay.
Okay.
So what happens is when the seller gives, this closing cost, the buy down, this money is going to sit in an escrow. And every month, the bank is going to pull a tiny bit from that escrow account, and they're going to add it to that lower mortgage payment to bridge the gap between whatever the final rate is and that initial start rate. Does that make
And you call
sense?
that what, a subsidy? A subsidy? It's called a
Yes,
subsidy, or it
yeah,
can
it's like
be.
a little subsidy that they have sitting there. They have an escrow account and they just pull, say, you're going to save, say, $200 for the first year every month on your payment. They are going to pull $200 every month from that escrow account to add
Okay.
to your payment.
But does that mean that the fee that is paid by the seller equivalent, like, is it equivalent to the total amount of that's pulled? Like, will it flush it empty, or is it more than, like, how does
It
that,
will
will there be
flush it empty.
leftover?
At the end of
Okay.
the buy down period, it will flush it empty.
Okay. Okay.
Okay, so really
So,
what that buy down fee is the cost difference between a 5% rate and a 7% rate, and then
that
a
makes sense.
6% rate and a 7% rate.
Okay. That makes sense. So I think it's probably good to show an example, because it really, like, rings true for me when I can see an example. So before I show the example, I want you to explain the requirements in order to have a seller buy down. So if we've negotiated, let's just say it's $5,000. We'll look at an example in a second, but let's just say it's $5,000, and we want to use that $5,000 for a seller buy down. Okay. What is required to happen prior to that even being a thing? Like, obviously we negotiated as agents, but documentation, like, what does that look like?
Yes. So from a realtor standpoint, you have a buyer that wants to do a buy down. You're going to present your offer. And in that offer, you're going to want to put in the comments, in the additional comments. The closing costs can be used toward, closing costs, prepaids, and or escrow fees, and or buy down points.
So the question that we had when you taught us this was, is discount points the same as buy down points?
No. Okay.
Okay, so we need to make sure
Discount.
buy down points are in there.
Yes, buy down points. Discount points are paid by the buyer, and they
Got it.
will buy down a rate for the life of the loan. And it is
Perfect.
usually a lot more expensive than this small seller buy down. So if you
Good.
can get those closing costs and use it toward buy down fees, then that's the way to go.
So what I wrote down when we learned this before was to add, even though, because our contract has, you know, at the very bottom, it had, well, CVR MLS contract has at the bottom where it says X amount of closing cost points, prepaids, discount points. I forget the exact wording, but it doesn't say buy down fees. I can tell you that. So we would need to add in the CVR MLS contract, paragraph 23, additional wording that would say closing costs to be used as closing cost points, prepaids, and or discount points / buy down fees.
Yes. Yes. Okay.
Additional
that
wording
would cover you. In addition to that, before you print your offer, you're going to want to call me and get a buy down agreement. Okay.
Yes.
That has to be signed by the seller and presented with the contract so that they know the closing costs they are contributing toward will go to those buy down fees.
Okay. It's a great point. So we have to have that buy down agreement prior to making an offer because it needs to be disclosed to the seller of what those, it's not just, hey, we want you to use $5,000 to buy down our, you know, a 2-1 buy down. We can't, even just writing it in a contract is not enough. There is an actual agreement that has to be submitted with the offer. The seller has to sign it when they sign the offer. And so they are just properly disclosed of what they're doing.
Yes. Yes.
Okay. That makes sense to me. All right. So I'm going to pull up the example of really quick. Let's see if I can find it. The 2-1. Oh, I've got a million up here. All right. Hold on a second. 2-1. 2-1 buy down on a 400. Can you see that?
Yes. Mm-hmm.
Okay. So this is on a $400,000 sale with a 5% down payment. So is this conventional 5%?
Yes.
That's correct?
Yes.
So $380,000 loan amount is what this is, right?
Yep.
So this is an example of a, this is a 2-1. And this is the example of what the agreement looks like from you.
Yes.
Okay.
Now, this is their payment schedule. This is not a buy down agreement.
Oh, hold on. Did I pull up the right one? Hold on.
You pulled up the payment schedule.
Oh, hold on. I'm sharing the wrong screen. 1 second. Because what I'm looking at is different. Hold on.
Okay.
You know what? I'm just going to pull up my, my desktop because that'll show you all the madness that's happening.
Here we go.
Hold, please. Hold on. Let me pull all of this down because then I have a million up, like I said. Huh. Okay. So I am at, here we go. This is the agreement.
This is
it. Okay. Explain this to us.
Okay. So this is the buy down agreement. It would be based on a $400,000 purchase price at 5% down for a $380,000 loan amount. One thing to know about this form, where you see it written at the top, $400,000 purchase price and all that up there, I added that. Okay. So your buy down agreement will not have that on there.
That's just for this example. Yeah.
Yes. Yes. Just so that we know apples to apples what we're looking at here.
Yeah.
So this is the agreement the seller is going to sign. And if you notice where it says buy down schedule, it will tell you what your rate is going to be for the first year. Okay. What the total monthly payment for just your P&I is going to be. That would be the total if the rate were, in this case, 7.875. Okay. Your buy down subsidy is the next column over, the 50742. That's how much that's going to be taken from this buy down account every month. Okay. And your remaining P&I that you would have would be $22.47. So you can see for the first year, they're going to save $507 a month.
By doing this.
Okay.
And now,
Yes.
reminder, this is just principal and interest. It is not taxes and insurance. So taxes and insurance, make sure that when your buyer is looking at this, they're not thinking their payment is going to be $22.47, because it's not. Because taxes and insurance have to be added into that. But that's what the principal and interest is going to be. Okay.
Yes. Yes. And then on the next row, it shows you what the payment's going to be at 6.875. Okay, so it'll have, you know, what your bottom line payment is going to be for principal and interest only. The wording underneath that, total buy down funds, 9196.20. That tells you as a realtor how much you need to collect from your seller to put toward this buy down fee. It is very important to remember, if your seller does not give you everything you're asking for in closing, it doesn't work.
Was going to be my next question. What if we can negotiate 5, but not 9? So it doesn't work for that. They're going to have to use it in closing costs in other ways, not with the buy down. It has to be the total amount, which is why it's important to have this beforehand.
Yes, because the buyer cannot pay anything toward this. The seller has to pay it all. Okay. So in this case, you would need to collect $996.20 in closing costs in order to make this work in a 2-1 buy down. If you couldn't get that much, your next best option is to go to the 1-0 buy down.
Okay, so let me pull that up really quick so we can look at the differences. So we're looking at a 2-1 at 7.875, $2,200, $2,250 for the first 12 months, $2,500, just say $2,500 for the next, and then it's going to go up to and I'm going to show that payment schedule too.
Yes.
Then it's going to go up from there because the 2 years will be done at that point.
That's correct.
And now, before I go on to that, before I go on to the 1-0, what's the question that I'm trying to ask? Oh, at year 2, like, so say when it gets out of this 24.96, we're done with that. We're going to the 7.87% initial note rate. Can you refinance?
Yes.
Can you refinance in the middle of this?
Yes, you can. And that's the beauty of this, that they allow you to refinance at any time. There's no prepayment penalty. There is nothing. So say within the first year, you want to refinance your loan, you can do that. Now, the seller has already given you $9,200 for this buy down. Say in 6 months, you want to refinance. You still have another year left on this buy down. What happens to that money?
Yes.
Okay. So the bank either has 2 options, and every bank does it different. They can either apply that money toward the payoff, which would allow you to pay off less, or they can just flat out give you a check. So
the buyer would get that money. It's not going back to the seller.
Yes,
though, correct.
It's always the buyer's money. Once it is collected
because they've
from the seller,
negotiated it.
Yes, it is the buyer's money. The only program that is different is FHA's program. They always, always, always apply it toward the payoff.
Okay.
Okay, so FHA will not give you any money back, but conventional may. It is really just up to
depends on the bank. Okay. All right. So I'm going to screen share the next one, which is the 1-0 buy down, just to compare the two. Do you see that? Oh, nope. That's the payment schedule again. Hold, please.
That's the 1-0 payment schedule.
All right, hold on. I shouldn't have opened them all before I got on here because, all right, 1-0 buy down agreement. Here we go. All right, share screen. All right, let me make it big so I can get everything else off here. Okay, here we are. 1-0 buy down agreement.
Okay,
so it's pretty much the same other than the fee.
It is, yes. And if you notice, your total buy down fee is $3,107. And in certain homes, it may be a little bit easier just to grab that $3,100. That is not a lot of money. So that might be easier to write in a contract instead of $9,000. So this would buy down their rate 1 point. for that first year. And the reason why these programs have become so much popular now is that the hope is that by the time that payment goes back up to the regular rate that it would, in this case, 7.875, the buyer would have the option to refinance into a lower rate. So
Gotcha.
knowing
But there's
that
nothing
rates
stopping
not
you before then. There's nothing stopping you before then if the rates go down
right,
drastically.
yes, mm-hmm.
Okay.
Yes.
Good to know. All right. So I'm going to, so we already understand the agreement. The next thing I want to share is the actual, what did you call it? A projection?
The payment,
payment
yes.
schedule.
Yes.
All right. So let me show that. Hold please. Okay. So this payment schedule that I'm bringing up, is this something that's given when they're getting this buy down agreement with you? Like, are you sending both of these documents at the same time, or is this only coming at closing? Or like, tell me when this comes.
This form is going to be in the buyer's docs, their loan docs, when they sign to take out the loan. The seller doesn't get this. This is for the buyer's benefit only. And the reason why this form is important is because when you send out loan docs on this program, everything that is written is going to have the higher rate on it. So their loan estimate is going to have the 7.875, which is their final rate. And it is done that way because that, in essence, is their rate. They are just temporarily allowing the rate to be lower for the first and second year. So this becomes important for the buyer to know, okay, so what is my payment for the first year? What is my payment going to be for the second year? And if you look on here, it'll tell you the first due date. Now, this is based on a loan that would be closing in November. Okay. So the first payment would be due January 1. And for 12 months, they are going to pay the P&I of $22.47, the insurance taxes $372, mortgage insurance $168, total payment of $27.88. Now, if you look up a little bit where it says initial legal obligation, the $32.95.77 tells you that is what your real payment is.
The max.
Yes.
Well, I guess it could change because of taxes and insurance.
Yes, your taxes could fluctuate, your insurance could fluctuate, but your rate, your payment is always going to be set at whatever that, final rate is. So it's not like an arm where it's going to go up to the sky. It is going to be set when you first take out that loan.
So if I'm a buyer and I'm trying to digest this, I am looking at worst case scenario. Worst case scenario in this situation is my payment. If I can afford $32.95 a month, then I'm pretty around that because of taxes and insurance. But yes. I'm feeling, if I'm comfortable in that, then this is a good option for me because you're seeing the max.
Yes. Yeah. They are seeing what their total obligation is. And then they're seeing how much lower that's going to be for the first and second year.
And the mortgage insurance that I see here, it tripped me up a second, but then I'm like, oh, it's because it's 5% down. So if we were putting 20% down, the mortgage insurance would not be in this equation. That's correct. You would not have that. Okay. Okay. That makes complete sense to me. Let me show, let's see here, 1 second. The 1-0 buy down. It's not very similar, but I mean, it just shows the different. I think it's helpful to see payments sometimes because then it inspires us as agents to say, hey, look, this is what it could be. Although I will say $400,000 loan, $3,000 payment doesn't sound appetizing. I know. At all. That's why this program helps at least alleviate some of that burden. Yeah. So this is the 1-0 and it just has the 1. So this is the max after the taxes, insurance, and mortgage insurance. Again, same thing, 5% down, $380,000 loan amount. Yes. The biggest thing I think I take away from this is we need to know what the fee is up front, which means we have to have the buy down agreement. The buy down agreement has to be attached to the purchase contract, purchase agreement, purchase offer when you submit it to the seller, with the exact dollar amount. Now, when I say that, I see it's like 16 cents, like, you know, $2,000, $3,000, 3106.16 or whatever it is.
Yes,
Is the 16 cents like very important?
it is. So
Okay.
what you could do in your closing cost is maybe just overshoot it a little,
Okay.
round it up,
Okay.
round it up to the next dollar.
Okay.
That way you've covered yourself. And then if there's any tiny bits of closing costs left over, well, they're just going to go toward, fees, taxes,
Fees.
escrows, things
Right.
like that. Yes.
Which brings me to my next point. So this buy down, talk about the max seller contribution part of it. So this is a part of the max seller contribution that we all know to be closing cost currently. So if you get $9,000, you need to make sure it's not maxing out for the program, correct?
That's correct. That's
Okay.
correct, because Fannie Mae, your conventional loans, have stipulations on how much the seller can pay toward closing cost. Okay,
Correct.
now FHA, you'll be safe with being able to claim a 2-1 buy down.
Right.
There are also rules in place that are more for us than you guys, that we have to pass what's called Mavent. And it just puts kind of a handcuff on us as lenders as far as what we can charge in a loan. Okay.
Gotcha.
So if you have a loan amount that is under $300,000, I recommend that you would call and make sure it's going to work if you want to do a 2-1 buy down. The 1-0 buy downs, we usually don't have very many, issues with. But those 2-1 buy downs, when we start trying to grab that large of closing cost, then we could have issues with Maven.
Right.
Okay. So we would just need to run the scenario. But yes, be careful that, you can claim the amount of closing you're asking.
So making sure if it's under $300,000 to check with the lender to make sure it passes all the tests if you're doing a 2-1 buy down. Okay.
Yes.
So keeping in mind the max seller contributions, asking those questions if you don't know. Let's switch over to the seller side. 1 second. Let me do something on my speakers. Okay. Can you still hear me?
Yes.
Okay. So let's talk about why a 2-1 buy down could be advantageous for a seller, because it doesn't seem advantageous to the seller right now because they're paying all of this money to help a buyer. But I will say, in this market, when sellers are not desperate, but they're like having a little bit more anxiety of why their house is not selling, and you hear the feedback of like, oh, the payment is too high because the interest rates are too high. Like, we've heard all of that. So offering a 2-1 or a 1-0 buy down as a marketing idea could be more advantageous to the seller than reducing their price, right?
Yes. Yes.
So,
well, it's kind of common knowledge that if a house sits on the market for a little while and then all of a sudden this thing comes up, price improvement, it kind of alerts everyone that, oh, we might have a seller that's going to negotiate. Maybe we can get more off. It's kind of a little bit of a stigma toward that home or that seller. So this way, being able to put something in there just to say, seller buy down help available. And
that's good marketing. It's different too.
Yes, it's a different way to approach it. So the seller is still getting the same amount that they want for their home. Rather than reducing the cost by $20,000 to get some new interest in the home, offer a temporary buy down help for maybe $9,100, and they are still going to come out $11,000 ahead.
Right.
Makes sense?
That's a huge win. And so Debbie has a sheet that kind of illustrates this, because if I'm thinking through how I'm going to talk to my seller about, well, have the discussion of why their house isn't selling and maybe need to reduce the price. This is a unique way to be able to say, hey, I have another idea before we reduce the price. Now, there are situations, I have one right now. it just needs to be reduced. Like
Yes.
throw out the whole buy down thing. Like
Yeah.
we can do that too, but the house needs to be reduced.
Yeah.
But if you're like beating your head up against the wall and you're like, I don't know what else to do for these people, coming with this idea that they probably don't know about and showing them, hey, instead of reducing 20,000, let's try this first for a couple weeks. I will market it this way. And let me show you how you're actually going to save $11,000 by allowing us to market that, but you have to be willing to pay, the 10,000 or whatever the fee is. And just showing them that. So Debbie has a what do you call this? Like
a matrix.
A matrix that actually shows the numbers. So you can see, now these are all hypothetical, clearly, but
Yes.
there are ways that you can put documents in front of your sellers to show them like why it might be more advantageous to try that. And as agents, we look super smart when we do that because sellers look at us as like, all they want to do is reduce our price.
Yes.
So there's,
yes, that's kind of the only answer out there for a house that isn't selling. Oh, well, let's reduce your price. So this is something fresh. It's something new that you can say, look, we can make this work and save you some money
right.
from having to go that, $20,000. You want me to lower it?
Yes.
So rather than doing that, come in with the buy down agreement.
Right. And then doing your marketing around what that looks like for a buyer, because the reason I'm doing this interview is because I do believe there's a lot of us that don't understand this at all. It's new to us. We haven't had to do any of this for so long.
Yes.
And, the more we're educated on the options, it makes us better agents to our clients, our buyers or our sellers. And so, do you have anything else to add that we need to know that's really important? I just wanted the basics, but is that anything else that we're missing?
That is pretty much it in a nutshell. I just can't stress enough to make sure that you find out how much you can claim in the fees and make sure that you are not underclaiming.
Got it. Because you won't be able to use it.
Right. Yeah. You won't be able to do the whole 2-1 buy down if you don't get enough money. But then if you get too much money, you're in trouble as well. So it is kind of a fine line on some of those sales that you need to really make sure that we work together to know what you're trying to accomplish.
And just a follow-up question for the contract, because we touched on it earlier. When we're filling out the purchase agreement, and this is, again, for CVR MLS contracts, which is the most common in our area that we use, although I know that there's multiple different contracts that people can use. But when we are filling that out, if let's just say they're doing, in this scenario that we've talked about today, is a 5% down conventional. So we would still fill it out as a conventional. We would attach the buy down agreement as an other attachment.
Yes.
And we would need to add the wording in paragraph 23 that would add the buy down fees as being allowable for that money. Because if you just put it, do you want to see it in the bottom? Do you know what I'm talking about when I say that bottom little paragraph where the,
yes, I do.
Yes. Do you want to see the fee there, or do you want to see the fee in paragraph 23? Does it matter?
Paragraph 23 would probably, be fine. I mean, you're going to put the closing costs that you're asking for in the closing cost blank on the, I believe it's page 1 or 2 of the contract. But then down at the bottom, you don't need to put the fee down there.
Just put the wording.
Yes.
Okay.
Yes.
So the total fee can still go in the blank where the fee goes. And then with the cents, that's, I used to laugh when people would put like 20 cents and I'm like, oh boy. But now it really doesn't matter.
Yes.
So making sure we have the total, and if there's more, then it can go towards closing costs. Like if you can negotiate more, as long as it doesn't max out on whatever program they're doing.
Yes. And like we just did one where they just kind of rounded up. So we have enough for the buy down fee, and then we'll have maybe a few dollars left over to go to taxes or something.
Okay. Perfect. And then what was the other thing? I think that was it. Pretty easy to understand once you walk through it.
It is. And we
Make
go over, the program with the clients as well, so that they know exactly what's going on, when their payment's going to change and things like that. We kind of walk them through.
For qualification purposes, they're just qualifying for the loan in general. So they're not, they don't have to have X amount of credit score to do a 2-1 buy down or 1-0. They have to just qualify for the conventional loan or the FHA loan with all the other requirements. And then this is an add-on to if they qualify.
That's correct.
Because they're qualifying on the initial rate. Okay.
Yes.
I think I got it.
Yes.
All right. Well, everybody, thank you for tuning in. Hopefully you learned something here. Debbie, we love her. She's full of knowledge and happy to like break things down in a really remedial way sometimes, because that's what I need. But thank you for being on here. And yeah, that's it. Hopefully we can get some of those done and get our buyers under contract when they're scared of these 7% rates.
Yes. Yes.
So,
thank you.
All right. Thank you.